Welcome to The Explainer. Have you ever looked at your car payment and just wondered, where does that number even come from? Well, today we're going to pull back the curtain and show you the hidden economic forces that actually determine what you pay for your car. So let's start with a question that sounds kind of out there. How can a trade dispute happening on the other side of the world possibly affect your car payment here in Canada? It might seem totally disconnected, but believe me, it's not. And by the end of this, you'll see exactly how it works. Okay, let's dive in.
All right, first up, I want you to think of a car finance company like the captain of a huge ship. They're about to set sail on this vast economic ocean. But before they can go anywhere or, set a price for a loan, they've got to check the weather.
And this is their weather forecast. These big macroeconomic indicators, things like inflation, interest rates, trade tensions, they're basically the wind, the waves, and the currents of that ocean. Every single one of them can make the journey and the pricing a whole lot smoother or a whole lot rougher.
Now, what's so interesting about inflation is that it's not just one problem. It actually hits you from two different directions. On one side, it makes the loan more expensive for the finance company to even fund in the first place. And on the other, it eats away at your purchasing power, making it harder for you to afford that loan. It is a real double whammy.
So, to navigate all this crazy economic weather, our captain needs some pretty specialized tools. And in the world of finance, those tools are core economic theories that help them predict what's coming over the horizon.
The first tool they pull out of the kit is something called the Fisher effect. I mean, think about it. How can a finance company possibly predict interest rates for a loan that's going to last for 5, 6, maybe even 7 years? Well, this concept is how they do it. It helps them connect the dots between today's rates and tomorrow's inflation.
And here's the crucial part. This simple-looking formula. It's the bridge that connects some big economic forecast to your actual reality. So when a lender sees predictions for higher inflation down the road, they use this exact equation to figure out what kind of interest rate they need to offer you today. Purchasing power parity is another key piece of this puzzle. It really just explains why exchange rates matter so much. If the Canadian dollar gets weaker, it's going to take more of our dollars to buy that car that was imported from Germany or Japan. And you can bet that price increase gets passed directly on to you.
Okay, now let's head down from the bridge and go right to the heart of the ship, the engine room. This is where we're going to see how all these theories and forecasts come together to create that final number you see on the price tag.
You see, the interest rate on a car loan isn't just one number they pull out of thin air. No, it's actually built in layers. They start with their own cost to borrow money, then they add on their operating costs, then a little extra as a buffer for risk, and of course, their profit margin at the very end. Now, leasing is a completely different ballgame. With a lease, it's all about prediction, and the single most important variable they have to guess? The residual value. It's basically a highly calculated bet on what that exact car will be worth when your lease is up in a few years.
And hey, if you've ever leased a car, you've probably seen this term money factor. Don't let the jargon fool you. It is just a different, kind of weird way of writing the interest rate. All you have to do is take that tiny decimal, multiply it by 2400, and voila, you've got the APR, a number we're all much more familiar with.
So a good captain isn't just worried about the weather right now. They are constantly scanning the horizon for potential storms. And in finance, these storms are all the different kinds of risks that could sink the ship. Managing them is every bit as important as setting that initial price.
The yield curve, think of it like the financial world's barometer. When it's sloping up like normal, that's a signal for economic growth, calm seas ahead. But when that curve inverts, when short-term rates are suddenly higher than long-term ones, that is a classic warning sign of a recession on the way. It tells lenders to batten down the hatches and be a lot more cautious.
And those warnings really matter because the company is juggling a whole bunch of risks at the same time, from interest rates changing to the simple risk that a customer just might not pay. But as you can see from this chart, the single biggest one they worry about is that residual value risk. It really is the art and science of trying to predict the future.
I mean, this is the multi-million-dollar question they have to answer for every single lease. What will this specific car be worth in 3 or 4 years? Because if they guess too high and then the used car market tanks, they could face enormous losses when thousands of cars come back worth way less than they expected. It's a huge, high-stakes bet on the future.
So we've looked at the economic weather, we've seen the navigator's tools, and we've spotted the risks on the horizon. Now let's bring this ship all the way back to shore and talk about what this really means for the car that ends up in your driveway.
And here it is. This is how it all connects. Remember that trade dispute we talked about at the beginning?
Well, let's say new tariffs are placed on EV batteries. Step 1. That makes the car more expensive to build. Step 2. That price hike adds to inflation, so the central bank raises interest rates to cool things down. Step 3. And suddenly, your potential lease payment gets slammed from both sides, a higher vehicle price and a higher interest rate.
So, the key takeaway here is pretty simple. The global economy and your own personal finances are way more connected than you think. What happens in a central bank report or in a trade negotiation or in a factory overseas, it doesn't just stay there. It flows all the way down, right into your monthly payment.
At the end of the day, being a smart consumer isn't just about haggling over the price on the lot. It's about understanding the huge forces that set that price long before you even walked in. Thanks for watching.